I can kick us off. Welcome everyone to the Eyes on Energy Tax webinar. We will have a PowerPoint slide with our three panelists, Nicole, Brad, and Mary Kate. I'm not sure which one of you wants to start. I think Nicole, maybe you.
I'm happy to start if you'll start sharing the slide deck. Thanks so much. Great. So welcome everyone. Thank you so much for joining the presentation that we have for you today on section 48C, the Advanced Energy Project Credit. Next slide, please. As Sarah kind of introduced us, your speakers today are myself, Bradley Seltzer, and Mary Kate Nicholson. We are members, we are all tax attorneys and members of the Holland and Knight Energy Tax Team. I should say that we are just a few members of the team here at Holland and Knight, and together we have just decades of experience, not only with 48C, what we're here to specifically talk to you today about, but a broad array of energy industries and a broad array of the tax incentives available to you. I have to do a plug. We appreciate you joining on this webinar. We didn't give you much time to do it. We will circulate, if you want to reach out after the webinar to us, we can provide you with a copy of this deck, which has a lot of information in it. And we also want to make sure that you're signed up to get our energy tax updates. We are producing as a energy tax team quarterly updates. And when you sign up to get those quarterly updates, it means you will also be receiving our client alerts that we do every time Treasury and IRS issue new guidance that's available. So we are really trying to push all of the kind of latest and newest information out to you. But to do that, we need your help. And please sign up, reach out to one of us to sign up to get those updates. Next slide. So today we're going to exclusively focus on section 48. This is just one of the many tax incentives that is available through the Inflation Reduction Act. In addition to thinking about 48C, we would highly encourage you to think about your projects as, whether any other tax incentives might apply. As we'll talk about today, 48C is an allocated tax credit. So there is only a certain universe of tax credits to be allocated. But what we were finding is that when we talk to many clients, it's possible that other credits that are not allocated, that are unlimited, may apply to your project. So think of 48C as just one of the many tools, one of the many tax incentives that's available to you and your project. The agenda is a pretty robust agenda. If we've done this right, we will allow questions at the end. We'll hopefully have about 15 minutes to do those questions. And we'll also be monitoring the chat box for your questions. But again, to the extent that we don't answer them, please feel free to reach out to any one of the speakers and we can engage after this webinar. We will be covering for you today some of the highlights of 48C, and as well as kind of a historical perspective. The IRA was kind of modified existing credits, created new tax credits, and 48C has actually previously existed and was enacted originally in 2009. So that gives us some information of how 48C under the IRA will operate. So we wanted to cover that with you. We'll also include some basic concepts, both that were included in the statute and in the recent guidance that Treasury and the IRS released. And we'll talk about, probably most importantly, that you're here today, talk about the process. How do I apply for a 48C credit? Next slide, please. Just to give you some highlights, so we're not kind of hiding the ball on you. The Inflation Reduction Act, as I stated, reinstated the Advanced Energy Project Credit. It's an allocated credit. Again, this is one where you will have to apply to receive it. Very unique in the tax credit space. And the important dates that you will want to put in your calendar so that we don't hide these dates are May 31st, which is when we'll see the ability to start submitting concept papers, and July 31st of this summer we're on the deadline for when concept papers are due. And we will discuss way more in this webinar about those dates and what is required, but wanted to put that right at the outset of the important dates to remember. I think I'm going to turn it over to Brad so we can talk a little bit again about the historical Section 48 credit to the extent it helps us inform and know what the new allocation cycle will look like.
Thanks, Nicole. We tend to think of this as a credit because it's denominated a credit. But I think it's often easier to think about allocated credits as almost like the equivalent of grants. This is a competitive application, and in terms of the process and the criteria that are going to be applied to these applications, it's pretty clear that the IRS and Treasury are not looking to recreate the wheel. There is a lot of history under the old 48C, and that process is literally being brought over and applied to the new amounts that are now available. So as Nicole mentioned, there is this concept paper that you will need to be provided. There's a set of criteria for evaluating those applications. Under the historical 48C, there was the same process for an initial DOE review and a recommendation and ranking of those projects it believed the IRS should make an allocation for. Certification application that is then filed, assuming you do get a positive recommendation. And then the rules requiring what do you have to do once you get an allocation to make sure that your allocation stays and you don't lose it for failure to either place the project in service or provide the necessary certifications. And the last thing is there has always been this desire to have transparency in who's getting the credits, and therefore there was a public announcement just to give you a little sense of just some of the projects that received allocations under old 48C. Ford got an allocation, significant allocation for changing one of its traditional manufacturing plants into a flexible manufacturing facility for EVs. Another taxpayer got a manufacturing credit for developing a lattice transmission tower in the United States. Another produced electrolyte solutions. So all different types of projects. But again, they're out there and you can get a sense for what's worked in the past. We can go to the next slide. One thing that you ought to realize about this credit before we sort of get into a little bit of the specifics is, and Nicole mentioned this a bit, is this is sort of like the catch-all provision. If you don't qualify under one of the non-competitive provisions, then you come here. And because the language is in many cases very broad and designed to capture things that might otherwise that ought to be eligible but aren't. And this is consistent with the whole move that Senator Wyden wanted to do with the technology neutral, is provisions. They realize that the code can't keep up with technology. and so this bucket is sort of there, so they don't have to specify everything. And but it is in a competitive environment and an application process. So Congress has allocated $10 billion. $4 billion of those goes to energy communities that hadn't received a credit application. As we'll talk about later, energy communities were defined likely by Joe Manchin to be places where your coal plants either were shut down or your coal mines were shut down, or you have significant unemployment associated with those closures. The credit is based on your qualified investment in qualified advanced energy projects. We'll talk about what those are. The credit can go from 30%. It starts at 30%. You could think of it as going down to 6% if you don't meet the prevailing wage and apprenticeship rules. It's probably easier to think of it the other way, which is assuming you meet the wage and apprenticeship rules, you're entitled to a 30% credit. You have 2 years once you get your certification to place the project in service. And there's some reciprocal provisions. So if you're a tax exempt entity of specified types, you can get direct pay. But if you're eligible for direct pay, it's not transferable. So you sort of get one or the other. They're reciprocal requirements. One of the things that Congress did to make sure that, again, this is the bucket that all projects that don't qualify elsewhere come to play, is you can't double dip. So you can't get a credit under 48C and also get a credit under one of the other provisions that were enacted as part of the IRA. The most likely overlap is 45X, which is itself a manufacturing credit. And there are statutory rules that basically say you got to go one way or the other. You can't do both. Let's go on to the next slide. One of the good things, and we'll talk about this slide in a minute, one of the good things about this credit, as we said, is that it opens this up for projects that would not otherwise qualify. That's sort of the good news. The bad news is that it opens up the number of applicants that can apply because more technologies are now potentially available under this credit. So there are trade-offs, but as we said, it is a significant credit and at 30% of your qualified investment, provided you've met the prevailing wage and apprenticeship rules. We can go on, and I think we're going to get some guidance now from Nicole.
Sure. Thanks, Brad. So those were the basics of both the historical 48C program and kind of the basics of the allocated credit, the value. And when we saw the statute, we were very, very excited. But the IRA gave Treasury and the IRS 180 days to announce this program. So we saw the statute and we were talking to clients about what the statute said, but we were very anxiously awaiting guidance. And within 180 days, which was what was required, give or take, I think a day or two, the IRS and Treasury delivered that guidance to us under 48C, and that guidance can be found in Notice 2023-18. The guidance certainly tells us a lot, and we'll be covering it in later slides, particularly about the application process. So what does the notice tell us? The first thing that the notice tells us is that the $10 billion that's up for grabs will be given out in 2 separate rounds. The first round, $4 billion will be allocated, of which $1.6 billion will be in those energy communities that did not previously receive a credit under the historical 48C, and we'll talk about kind of where those are in a minute. So we now know that there's going to be 2 rounds. So I think that the bottom line there is, if you're feeling like I'm interested in this credit, I would likely qualify, but there's no way I can make this summer, be aware that there is intended a round 2. In addition, there could be likely possible future rounds. What we saw in 2009 is that there are circumstances where a taxpayer can receive an allocation and get certified, but doesn't hit the requirements to place it in service. So those credits that kind of go back in the pot, so to speak, of the amount that can be allocated to other taxpayers. So again, the guidance did tell us that there will be 2 rounds, and lots of clients excited about just this first round. The other thing that it told us a lot about, which I think, to Brad's point, really looks like how we did it in the past, was that the guidance did walk us through somewhat the process. This idea that Mary Kate will talk about, where there's a concept paper and then there's an application. Not surprisingly, the guidance also heavily indicated that while this is a tax credit, the DOE is really in the driver's seat here. and really will be the one making decisions on how do I prioritize which projects should receive an allocation. The IRS is not well suited to do that. And historically, and in this new 48C, will be relegated to DOE to make those determinations. It also tells us a lot about the compliance and the reporting requirements, and that Mary Kate will be walking through. So, for example, what happens when there's been a change in circumstances? I told you, DOE, that I was going to build this, but I want to build this, or ownership has changed in my project. It is kind of a robust process from beginning to end, from applying to placing in service, and to all of the things that you will have to prove up to DOE and to IRS, which to our point makes other credits perhaps look more attractive. There are some things that we didn't get in that guidance. And what Notice 2023-18 said is that IRS and Treasury will be issuing further guidance in May, and perhaps, I guess, before. So we got some of what we were looking for, but not everything. I think IRS and Treasury did the best that they could, given they had only 180 days to stand up this program. But there are certain areas, and certainly when we get in the nitty gritty, where we hope that May 31st additional guidance will address. Next slide, please. So now Mary Kate is going to talk to you. We've been talking about, the credit is 30% of qualified investments in qualified advanced energy projects. What in the world is a qualified advanced energy project? Mary Kate?
Thanks, Nicole. Yeah, so first of all, I just want to say that, we're basically talking about three categories of projects here. And the three categories are established by the statute. So the Inflation Reduction Act significantly expanded, as compared to prior 48C, the types of projects, as I'll refer to them here, that can qualify for an allocation, which is great. And as Brad said, is right in line with kind of the shift that we're seeing in the energy tax credit space as a whole, to kind of be more accepting of new technologies. So the first category that we're talking about are projects that either re-equip, expand, or establish industrial or manufacturing facilities for the production or recycling of all of these items. So this category one, I kind of think about if I were to establish a facility or re-equip a facility, and I wanted to, for the purposes of getting the Section 45X credit, that those types of facilities would be eligible under here. Like, as Brad said, you can't get both 48C and 45X. There's an explicit anti-double dip provision within the statute. But if you're kind of trying to think about what kind of projects would be eligible, that kind of gives a good guideline. And something that the Notice 2023-18 did was it provided examples of eligible projects for each of the categories, and actually for each of these sub bullets. So if you have a specific project in mind, you can actually go and look at those examples. Obviously, it's not it's not an exclusive list, but it can kind of give you an idea of what can qualify under the statute. So, for example, we're talking about facilities that manufacture solar panels, wind turbines, offshore wind platforms, microturbines, grid equipment for electricity delivery, any type of carbon capture equipment or components, electrolyzers, battery and plug-in hybrid vehicle equipment. And if you notice, what's really interesting about this provision is that it has this last sub-bullet, which basically says other advanced energy property designed to reduce greenhouse gases as may be determined by the Secretary, which is extremely broad, and which really represents an incredible opportunity for, if you don't see yourself fitting into one of these, it's a great opportunity. As Brad said, it kind of does open up the credit to, an enhanced amount of technologies, but really someone has to get these $10 billion in credits. So you have no shot of getting those unless you try. In notice 2023-18, the Treasury did go ahead and clarify that components and equipment for nuclear power reactors is one of the technologies that they are focused on and have identified as one of these other advanced energy property projects.
One of the things that this category tends to do is to focus on the end products. There is no definition of a facility in the statute, but I would say that the point you just made, Mary Kate, about the nuclear plant and the components, that's the way a facility was defined under the '86 Act when you had the transition rules for nuclear.
Mm-hmm.
It included all the equipment, contained in that facility. So there is some guidance out there, just not directly applicable.
Yeah, and as we'll get to in a second, the guidance does kind of touch on what it means to be an industrial or manufacturing facility, but those definitions are kind of wishy-washy. So, they are not the clearest that they could be. So moving on to category 2. So I kind of think about this category as the retrofit category. So we're talking about existing industrial or manufacturing facilities that taxpayers are going to re-equip with equipment designed to reduce greenhouse gas emissions by at least 20%. And the IRS has already identified in the notice that they will provide future guidance on how to exactly measure and determine if your technology or if this re-equipment of the facility decreases greenhouse gases by at least 20%. That's going to be addressed in future guidance. And someone asked a question about what areas we expect to be addressed in additional guidance, and throughout this entire presentation, I think we're going to give you a little nuggets of additional areas that we need more guidance. That number one, the IRS has said they recognize more guidance is needed here, and number two, we also see kind of holes in the process. So, kind of looking at what are the eligible projects under this category. Some of the examples provided in the notice are electric heat pumps, combined heat and power systems, technologies that reduce direct fuel use, electricity use, or waste. So perhaps, the installation of an energy or a waste heat recovery system, electrification of direct fuel use processes, adoption of renewable or low emissions fuels and feedstock. So for example, you have a manufacturing facility that uses, a high carbon fuel source. You switch to a low carbon fuel source that would qualify under this category.
One thing that's interesting about this category is there's no requirement that this be innovative. I mean, you can go buy off the shelf stuff at your Home Depot, get a east weight, some kind of equipment that's going to reduce your greenhouse gases, and it's potentially eligible, even though it's an off the shelf, product.
And I think what makes this unique is, and it took me a while to appreciate this, when the previous slide looks at what are you making, and this really, you could be a widget maker factory, but you are decreasing your GHG emissions. So it doesn't really care about what you're making; it cares how you're making it.
Correct.
Yeah, absolutely. And of course, and also this again. This category has the same catch-all provision at the end where, any kind of technology designed to reduce greenhouse gas emissions. So I would say don't be discouraged if you don't see, your type of technology or your process called out on these lists. They would not have put this, provision in the statute unless they wanted taxpayers to take advantage of it. And again, recognition of the fact that technology moves faster than the code certainly does. So moving on to the third and final category, we're talking about projects that re-equip, expand, or establish industrial facilities for the processing, refining, or recycling of critical materials. So critical materials include critical minerals. And the critical minerals have been published. They're published on in the Federal Register at 87 FR 10381. And in our alert that covers notice 2023-18, we link all of the guidance that the notice talks about. So if you want to go and look at, or if you want to email us and you want to go and look at that list of critical minerals, we can certainly provide that to you. In addition, the Secretary of the Treasury did say in the notice that they will provide a list of additional critical materials by that same May deadline. To this date, there has been no list of critical materials published. So I'm sure that there are those other than, those interested in 48C that would be very interested in seeing that guidance come out. And hopefully, when you kind of think about processing, refining, and recycling, that's very broad when you're talking about even critical minerals here. And so the notice does provide some examples of eligible projects. So for example, any facilities that process raw ore, brines, mine tailings, end-of-life products, waste streams, or other critical materials into critical materials. However, any facilities that process critical materials into derivative products, such as metals processing, are not going to be eligible under this category. But lots in the critical material, and specifically the critical mineral space, are going to be of interest. I think, some of the electric vehicle credits, 30D, has a large critical mineral component that's going to be coming into play here in the next couple of years. So hopefully this is going to bring some of that much needed critical minerals into the United States. And kind of, each of these categories talks about the fact that we're dealing with a type of facility. And as kind of mentioned earlier, these definitions do seem to overlap a good bit. The big difference between an industrial facility and a manufacturing facility is that the manufacturing facility, you're really dealing with, as Brad mentioned, kind of finished products. But even you can see that there is overlap here as well. So these are just some things to keep in mind when you're trying to decide as a threshold issue if the project that you're considering qualifies under 48C. But these are super broad, so I would expect that most things are going to go from this perspective. And I'm just going to say, Nicole is going to turn it over to you.
So jumping in there. So one of the themes of the IRA was certainly this idea of equity, deploying tax incentives to communities that had been perceived to be left behind. And so the way that the 48C allocated credit does this is it says of the $10 billion that can be allocated, $4 billion has to be in energy communities that had received no prior 48C allocation back historically in 2009. It defines energy communities, and Brad told a joke that this was a Joe Manchin special. I cannot confirm or deny that. But you will see why he said that, which is because the energy community definition is very focused on coal. Previously, places that had a coal mine that was closed, or had a generation unit that was retired, or any census tract adjacent to that. I have seen good maps out there of where those locations, where those census tracts are. But on top of that, you have to layer what census tracts received or did not receive a prior 48C allocation. And that map is not readily available. That is one of the things that Treasury and IRS has said they will publish in future guidance. So we are still awaiting to answer the question that was in the chat. What are we still awaiting? This is, I think, a key piece, because if you can cite a project in one of these areas, you will have, I think, a better chance, because they are required to put $4 billion of this allocation to these places. Once that is kind of published, What the guidance says is that, taxpayers, applicants are going to be able to figure that out on their own. And DOE will confirm that. And if you are going to move from that area, as Mary Kate will suggest later, there would be a change in circumstances, and that may very well affect your allocation. So you've submitted an application, for example, to be in an energy community. You've decided that's not the right location, I want to move it. That could very well impact your eligibility on the credit. But this is one area where we are waiting to receive future guidance on 48C. Next
And
slide.
I was just going to add really quickly, Nicole. I think the fact that the determination of where the project is located, the fact that that determination will not be redetermined is helpful. One thing that some taxpayers have been concerned about, when just thinking about the energy community, the bonus that applies for a lot of different credits that also references these census tracts is the fact that census tracts can change over time. Now, it's rare for census tracts to change, but what if that were to happen? And the fact that you don't have to worry about that here, because if they determine that you're in the census tract, then you're in it and you don't have to worry about any change in the future.
Okay. Thanks, Mary. So another theme, in addition to making sure communities aren't left behind, and as Brad alluded to, is the focus, not just in this credit, but on most of the credits, on making sure we are onshoring jobs to the United States and paying living wages. And the way that the IRA does this is that it's not, in my mind, a requirement, but it is a condition. And if you meet the conditions, the labor conditions, you go from 6% to 30%. I will tell you that most of our clients are aiming for the 30%, which is why, Brad, it's sometimes easier to think about it as a 30%, but you go down to 6%. Technically, the way the law is written is it's 6% and you get a multiplier of 5 if you meet these labor conditions. But it's just such a big bonus that it makes sense to absolutely ensure that your project will meet these labor conditions. The labor conditions have two parts. One is around making sure you are paying mechanics and laborers a prevailing wage. It is based on a law that has been around for many, many years, Davis-Bacon, since 1931, I believe. And so some people are very familiar with what it means to be paying mechanics and laborers a prevailing wage. Those are wages that are published by the Department of Labor, and it's based on location and based on what type of worker. So you'll want to make sure that any mechanics and laborers, which includes subcontractors, are paying these wages, or are paid these wages, or I would say in this instance, and in the apprentices, which is the part 2 of the labor conditions, there are some self-correction penalty procedures available. So the law contemplates on this that there will be mistakes potentially made. And if you self-correct, which is basically grossing up your mechanic, and pay a pretty hefty fine to the IRS Treasury, you will deem to have met those prevailing wage rules. So again, the law does contemplate these kind of errors that can be made. In addition to the prevailing wage piece, the other second part of the labor requirements are around apprenticeships, the requirement that you are going to hire certain types of qualified apprentices in the construction, repair, alteration of these projects. The IRS has issued guidance on this. That's what we refer to as Notice 2022-61. So be aware as you're planning for the 48C application, this is something that you want to hit, and you want to make sure you account for it in your planning. DOE, as part of the process, will want you to certify that. So there are two parts in your application, which we'll talk about the process in a minute. You're going to want to say that you're going to meet these labor conditions. And then later, you also have to, again, part of this 48C is just the kind of the paper trail confirming with DOE that you have, in fact, after all, met these requirements. So again, something to aim for, increases the credit by a lot, and not something you want to miss out on. Next slide.
And, Nicole, we have a question that I think is really relevant here,
Yeah.
Asking about whether these requirements are just on construction, but also ongoing operation. So I don't know if you want to.
Go for it.
Oh, yeah. So, these requirements apply to construction, and then alteration or repair of the projects. So typical, maintenance and operation, it doesn't apply to that, but it does apply to construction, alteration, and repair. So it's a great question and something, and that is true for all of the credits that the prevailing wage and apprenticeship requirements apply to, which are most of them. It's true for that as well.
Yeah, you're really looking at costs incurred up until the placed in service date for all practical purposes. So
Good. Next slide, please. And
I think this is back to me. Yeah. So there is, Nicole mentioned earlier that once you get your certification, you have 2 years to place the project in service. Now, this is a substantive requirement. So if you don't place the property in service in 2 years, you just lost your allocation. It goes back into the pool. And if you're looking for areas where we need more guidance, we'll have to figure out or be told what happens when it goes back into the pool. Does it become a round 3 or something, or in addition to round 2 or something like that? There's also a notification requirement that you have to tell the DOE when you actually do place the project in service. And as we just mentioned, you also have to certify that you met the prevailing wage and apprenticeship requirements. It's not entirely clear to me whether the notification rules are procedural or substantive. So let's say you place the property in service within the 2 years of your date of certification, but you don't send the DOE for some reason your notice that you did it, or your notice that you met the prevailing wage and apprenticeship requirements, but you did. Does that impact your eligibility for the credit? Or is the important thing that you got the property placed in service within 2 years? I don't know. It's not the type of thing that the service usually tells you when it issues guidance, but we will look to see whether these rules are viewed by the service as substantive or procedural. Next slide. We talked earlier about, the criteria. These are the criteria that were used under old 48C, not surprisingly. And what you will see is a number of criteria, all designed, for the purposes for which this credit was established. But there is no ranking. So this is just a list of factors that the Treasury and the IRS will take into consideration. And as we mentioned before, there are trade-offs. So if you consider commercial viability and time from certification to completion, those are all about speed, right? Getting projects completed quickly and placed in service. Some of the others are much more designed to look at the impact. So how innovative are they? And how much, do you do more than 20% reduction in your GHGs? Are you able to achieve 30%? And one of the squishy ones, which will be a challenge, I think, is job creation, and how that works in a competitive environment. I mean, you may say your project will employ 4 workers, and that sounds good until you find out that you're in competition with somebody else who's going to employ 100 workers. And so that's part of the challenges of this, competitive environment. But I don't think you'll see a ranking of these. I think they will just simply enjoy the flexibility they have in making these recommendations. It is a funny process in the sense that DOE makes this recommendation to the IRS, ranking the projects that it believes deserve to be funded. but that actual determination is made by the IRS as to how the allocation. And, you know, this will be a little bit of a challenge, I think, because, you know, honestly, the DOE is probably in a better situation to judge the value of these projects than the IRS is, but nonetheless, that's the process that we have. I think we can go on to the next slide.
Thanks,
I think
Brad.
this-
So, you know, as Brad talks about the criteria that he's talking about, that's all in the statute. So statutorily, DOE and the IRS have to follow, have to abide by those criteria when judging whether projects are eligible for an allocation. I'm going to get into more detail on the process in just a second, but the first step for an application, and the important date that Nicole was talking about, of the round opening on May 31st and closing on July 31st of this year, is the submission of a concept paper. And this is very similar to how DOE grants and cooperative agreements and loans are done. There's first a concept paper, which kind of provides an overview, gives the DOE enough information to think whether this really is a viable project that could be eligible under the program, in this case 48C. And then after that, it's kind of a no-go decision from the DOE, an encouragement or a discouragement, and then a full application. And so with historical 48C, one of the big pieces of guidance that we are waiting on and we're hoping to get well in advance of that May 31st date of the round opening is the detail of what exactly has to go into that concept paper. But because these categories, this statutory criteria on the left here are the exact same as as prior 48C, we can kind of anticipate that what the concept paper requirements are going to be similar to what IRS and DOE requested in the past. So here's just, you know, some information that was requested in the past. And so as you're thinking about, even before we get that next set of detailed guidance, really detailing what has to be in the concept papers and full applications, you know, we can look to this past guidance and go ahead and starting to make sure that you kind of have an idea of what your answers to these questions would be if you are interested in applying for an allocation of the credit.
The one thing that the prior guidance didn't do was address critical materials.
Yes,
So
that's true.
That is a place where they're going to have to create this from the beginning. So
Absolutely, absolutely. So kind of walking through the full process, which we have been referencing throughout the presentation. So how do you really go about getting a credit? So as we just discussed, you first submit the concept paper. Round one is going to be by July 31st. So assuming that Treasury and IRS do not get any more guidance out to us until May 31st, which is their self-imposed deadline, you have 2 months with the full guidance in front of you to prepare your concept paper. The DOE then reviews the concept paper and sends the taxpayer a letter of encouragement or discouragement. Even if you get a letter of discouragement, you can still submit a full application, but your chances of getting an allocation are just not going to be as great. The DOE then reviews the full applications, conducts a technical review, and then provides their recommendation to the IRS, ranking the applications as Brad said. Then the IRS makes a decision regarding accepting or rejecting the projects. The IRS then has to certify the projects, and in order for a taxpayer to then claim the credit on their return of the year that the project has been placed. And interestingly enough, so all of these requirements are going to be done through the DOE portal, which is not something that a lot of taxpayers probably have experience with, but the business development side of your companies probably have a lot more experience with that if they've been going out and getting, you know, DOE grants, loans, or funding of that sort. And Brad alluded to this a little bit earlier about some overall reporting requirements and deadlines. But kind of just the key one to keep in mind is that these reporting requirements, if you don't abide by, you know, notifying the DOE that you have met all certification requirements, which basically means you're ready to begin construction and get the project placed in service. And then secondly, notifying the DOE that you have placed the project in service, then your allocation can be forfeited. So you do want to make sure you don't have a foot fault on those two reporting requirements. And then finally, as Nicole alluded to earlier, if you do have a significant change in your project from the plan set forth in your concept paper and application, then the project will either no longer be considered if you're still in the application phase, or if it's post allocation, then that allocation is void. So suffice to say, you don't want to have any big changes. If you have a change in round one, it's okay. You can go ahead and apply for round two. So all hope is not lost. But that's just to say that this is not a situation where you can kind of put forth a vague plan and then expect to kind of fill it out later without the IRS and the DOE kind of turning their nose up at that. Now to the very important topic of, what are you going to do? Yeah.
So one of the probably the most exciting things about the IRA, in addition to just the, enhancement, modification of existing credits, creating new credits, is this ability now for the first time to monetize these tax credits. And that happens in two different ways. One is the direct pay option, and one is the transferability option. For most of you who are for-profit companies, 48C, and there are different rules, slightly different rules depending on which credit you're in. But for those of you who are on the phone, direct pay likely will not be an option for 48C because you have to be a tax exempt entity. So think about your states, political subdivisions, Native American tribes, charities, things like that. Those entities, because they don't pay federal income tax, can get to direct pay. What is direct pay? I think of it, I simplify it as a check in the mail, right? It isn't a credit off of your tax liability. And there is some additional requirements on domestic content for those electing to direct pay. 48C is different. Again, 45X, if we're talking about that, which is another manufacturing credit someone mentioned in the chat, different rules on direct pay. But most of you will be able to, if you're not going to be able to direct pay, transfer these credits. What does that mean? Transferability basically means selling a credit. So while we traditionally relied heavily on the tax equity market, sometimes when we had tax credits but no tax liability, or we weren't interested in the tax credit, we relied on tax equity. This is a very, very unique opportunity, although a lot of it is kind of how the market will react is to be determined. But the IRA tax credits, generally speaking, are transferable, which means they are available to sell to an unrelated person for cash. And we expect a lot of excitement in that area and are already discussing with many about, what the marketplace will look like for the sale of these credits. But something to keep in mind, if you are normally in the mindset of tax credits don't help me, I'm a startup, I don't have a lot of tax liability, remember that there is this ability to harness 48C through a monetization of this tax credit. And I think that left us, Mary Kate.
Yeah, I was just gonna ask Small before we open up for, answer all these questions we have. I do think it's gonna be interesting when you think about transferability. A big question going around right now is what is the diligence gonna look like on the purchase of a tax credit? And when you have the situation where it's an allocated credit and the DOE has already done a lot of the diligence for you into determining that you are eligible for, and the IRS, approved that credit. I do think it's going to be interesting to see if 48C becomes one of the credits that is a little bit easier for those looking to transfer their credits.
So in sum, I would say, feel free again to reach out to any of us. We're going to take some questions, but the deck will be available. Reach out to us. A recording of this will be available. 48C is certainly a very interesting tax credit, but it's unique in that it's allocated. So there is some competition here. And as we said, it is kind of a catch-all. So if you don't find yourself eligible in other credits, certainly 48C is something that you should be looking at. And super exciting because it is able to be monetized, but it does come with some requirements, such as the requirements to apply, some reporting requirements, and kind of some other bureaucracy. I'm going to read some questions, team, if that's okay, and we can try to answer them. I saw a really interesting one about how 48C interacts with 45X, and wondering, Mary Kate, if you want to clarify it. They say, does this mean, how does that overlap exactly work?
Yeah, so let me pull up the exact language. So in essence, if you get an allocation of 48C that you use to build a facility that then goes and manufactures products that would typically or that otherwise would be eligible under 45X, those projects are not treated, or those components are not treated as eligible components under 45X. So they would not be eligible to receive the tax credit under 45X. So it's really a lot of times when it's going to depend on when you run the model and see, what am I better off? Am I better off getting, a production tax credit, which is what 45X is, or am I better off getting, an initial upfront investment tax credit, which is what 48C is.
Thanks. One of the other questions I saw, and maybe it was answered, but I suspect a lot of people have it, which is, how does this 48C, we talked about the general no double dipping between tax credits, but how does that work with DOE grants? And can you take advantage of DOE grants in this credit or other federal funding, or how does that all work, and what does the notice said? And I know we were talking about it internally as a team this morning.
Brad, do you want to take that?
Yeah, I just think that they recognized that the grant program existed outside of 48C, and it contemplates that there's no prohibition on receiving, unlike the credits, there's no prohibition on receiving other DOE grants and still being eligible for 48C. Now, that doesn't mean that the DOE won't take into account the fact that there's other DOE funding and trying to decide whether it makes sense to award additional funding, but there's no exclusion as there is under statutorily, as Mary Kate mentioned, between 45 and 48.
And then you also have to consider, when you're talking about what is my basis here for purposes of the actual tax credit, you have to look at the terms of the grants, the terms of the funding as well, because that's a super important question.
Thanks. The other question was, okay, so we submitted a concept paper. What is the time lapse between I've submitted a concept paper? When will they get back to me that my application is encouraged or discouraged? And once I submit that application, when will they finally let me know? To be determined, I would say.
Yeah, I would say, all the steps are there. Well, I think what's helpful is that we know that there's a 2023 allocation and then a 2024 allocation specifically. So they have to get this done this year so that next year they can turn to the 2024 amount.
Correct.
Or what I'm guessing they're going to do a yearly amount. Yeah.
But to be clear, the guidance or the statute doesn't have any specific dates.
Exactly. Yep.
So we are TBD. I would guess it depends on how well staffed up they are. The question came in is, does early submittal of a concept paper improve position? So, the concept paper, we said it kind of opens up May 31st, and kind of the absolute deadline is July 31st. Should I try to aim for earlier in that time frame or later in that time frame? I don't know if you have any thoughts on that.
Yeah, I wouldn't think that it would matter, honestly. I think it's better to have a fully locked and loaded paper than rushing anything.
Yeah, and I think this is having some experience witnessing my colleagues who do a lot of DOE stuff. This doesn't feel, and historically was not, like a first come, first serve situation. So they are going to be prioritizing and ranking projects. DOE is, and so I think you would want to you certainly don't want to miss the deadline. But I don't think there's going to be this huge rush to get in the absolute first day. I suspect to prioritize and kind of rank projects, DOE will be looking at all of those kind of on the table and making that decision at the same.
I don't think this is rolling admissions.
Correct.
One question that came in was, and we've mentioned a few of these along the way, what guidance are we expecting? The notice itself has information that tells you about the additional guidance they expect to provide. So it would be helpful just to refer to those if you want to know what guidance at least the IRS thinks it needs to issue.
Question is, what approach should we be taking right now with Treasury to influence forthcoming guidance? Where we have been doing and working with a lot of clients is reviewing the statute, reviewing what guidance is out there. And if there is uncertainty there, working with Treasury and IRS through the comment letters or through meetings, making sure that when that guidance comes out, it clearly is beneficial to our clients. So certainly if you're seeing issues here in this statute or in what the IRS has said in this guidance that was just released, and there's an open question, we absolutely encourage advocacy before Treasury and IRS as they are looking for stakeholder input. And certainly it's sometimes the stakeholders who best see those holes in guidance and are able to point them out.
And especially with the kind of, I was going to say the kind of those broad buckets at the end of category 1 and 2, the IRS specifically said in this notice that they will either identify those additional kind of greenhouse gas reduction technologies or projects that they approve of, either through additional guidance or just when you receive, an allocation of the credit. That's when you'll find out that they see that as an appropriate further project. But there's nothing wrong with going ahead and advocating for additional technologies to be specifically identified in future guidance. Not only will give you more comfort, but also help additional taxpayers in like round 2 and so on.
Mary Kate, will you go to the next slide? Because we're out of time and I want to make sure people have our contact information. Yes. Oh, so this is just the 3. If you want to reach out to us, this is my contact information. We are all, again, tax attorneys at Holland and Knight. This is Brad. We're going through these quick, but they were at the outset as well. Feel free to reach out to us. If you have a question that we didn't quite get to answer, I tried to pick out the questions that I thought would be applicable to most of you, but I realized that we did not get to absolutely all of them. But it's been a real pleasure. Thank you so much for joining. Please be sure to sign up to our energy tax updates, where you will get all of our client alerts, including one that we have on 48C. And it's been a pleasure. Have a great weekend, everyone.